G'day expats, ladies and gentlemen, and welcome to another episode of Expat Chat, episode 155. And today we're doing a bit of Q&A and a quick shout out to our Facebook group, the Australian Expat Financial Forum. Over 3,500 Australian expats are in that group right now, and there's some great things that go on. A lot of questions, feedback, support, help given to each other, and it's a great community that we love to see keep building. As always, I'm joined with my co-host, Brett Evans, the Managing Director and Founding Director of the Atlas Wealth Group, Managing Director for the Europe, Middle East and Africa regions. Great mate, business mentor, everything, all the above. Good morning, Brett. How are you?
Purveyor of crap.
Mate, how are you doing? You've just returned from Doha, a quick little trip, bunny hop trip over to Qatar for the masterclass, which was only 2 days ago. How'd it go?
Mate, great success. It's
Yep.
Doha's cool. It's funny how people ask what's Doha like, and it's like a mini Dubai with a blend of
Hmm.
Abu Dhabi. It's very
Yep.
root.
Yeah,
Dubai.
cool.
If you land from space in Dubai, you won't know where you are. Whereas in Abu
Hmm.
Dhabi, you're in the Middle East.
Yep.
Doha is probably a blend of the two.
Yep.
Really cool place. Lots of Aussies over there having a great time, and they themselves love living in Qatar. Had a
Hmm.
great session. We had about 42 people, I think it was, at our
Mm.
masterclass. It was fantastic, and everyone stayed to the
It's
end, which is
great.
always a good sign. They're not running to the
Yeah.
door to get out of there quick smart. So thank you for the folks who, and there's a lot of actually people over there, that listen to us, which is cool. So
Yeah.
the podcast comes up quite a bit. So thank you to everyone who turned up for that. Hope you walked out of that evening with a bit more information than when you started. Yeah, we
Yep.
got a bit of food into them, a couple of beer and a bit of wine. So yeah,
Lovely.
it was a good night. So, and folks, if you're new to the channel, g'day, and joined by my mate and colleague and managing director for the APAC region, Mr. James Ridley, who just before the call we're just sharing notes about kids. James has got a little rig that is coming to the world, and he's a unit. We're just talking about a future
Well,
wallaby there.
yeah. Well, Harvey, he's an absolute chonker. He's putting on about 400 grams every week, and just a very good baby.
Yeah.
We're having a really good run at the moment, so must be doing something right. Otherwise, he's just a good boy. So we're very grateful for that at the moment.
100%, mate. Yeah, you take each day as it comes and each week as it goes, and it's a nice experience. It's the coolest thing ever. It's money can't buy. So,
Mm.
hey, let's get the show on the road. As you said, we are going to do a bit of Q&A on the Facebook group. It's there. It's a great network and community. There's 3,600 members on there sharing ideas, questions, queries regarding managing their finances as an expat. And before we go any further, let's keep the compliance officers of the world happy. All the information that we're going to share with you good folks today should be treated as informational and educational purposes only. Please do not construe this as financial advice. If you do need to get advice, if you do need to get something specific to your personal circumstances, reach out to a specialist like Atlas.
Absolutely, mate. And we'll jump straight into the first question from Sean. Great question here from Sean. And he's already mentioned it. I know it gets asked a lot. As an expat, I'm considering buying a property back in Australia. Initially, it will be to have as an investment with the view to possibly move into for retirement. What are the tax implications of this, and how can I secure a mortgage of that property, or for that property, I should say? So good question around the tax implications, whether it's the right decision to buy now or when you return to eventually move into. Oh, there's so much in that, and I feel like this is a topic in itself that we could
We
probably
could talk
talk
for 20
about for
minutes on,
hours on
yeah.
end.
Yeah.
Yeah, that's right. Let's start with the easy stuff, tax implications. So, I mean, first off, because you're buying an investment property as a non-resident, a non-resident, it does mean that you miss out on the tax concessions of the 50% CGT discount concession on the growth of the property from the first day that you buy it. But not only that, the property itself, if it is positively geared, and that means that your income is more than all your tax deductions, your income tax rate is a little bit higher, and some would say punitive, where you're paying a minimum of 30% income tax on the income itself. Property is a nice asset, but as an expat, it's just not the most tax efficient asset compared to probably other asset classes that you could invest in.
Yeah.
It might be a nice to do to buy an investment property now and for it to be a retirement property that you move into later. But I will say I have not seen too many clients successfully complete that where they buy it as an investment and then they move into it in retirement. And it's just because their personal situation changes, and their personal preference for retirement changes as well. Often there's better asset classes which will outperform property rather than putting maybe all your eggs into one basket just so you're ticking that box for when you eventually come home. I think, as I said, there's a lot that can come into that. Securing a mortgage. I think there's still a couple of myths getting
Mm.
around in the expat groups. As an expat, you can get a mortgage, but you do need to use a specialist mortgage broker so they can apply your situation to, I guess, the credit guides of a lot of different mortgages. Um, the team here with Atlas Mortgages, especially Kirsty and Jeremy, they do some great work there, and they just have to have a firm understanding of your situation, and then they can put you through the process of getting a pre-approval. And often they're just trying to select the best mortgage for you. But yeah, there's a little bit in that in terms of whether buying investment property right now is suitable versus later in life, depending on what you're doing with your other assets.
It's spot on. I think I gave an example at the Doha seminar showing that a CBA would offer a Doha resident a $300,000 mortgage, but another bank would offer 1.1 million. And
Yeah.
that's basically the same person, same circumstances, just a different bank. So people are wedded to their banks. They had a dollar
They
mine
are.
account with the CBA since they were 5. So they're like, oh, no, I've been banking with the CBA for the last 30, 40 years. Means nothing, guys. And
Yep.
that's the important consideration to take out of this. It is something that at the end of the day, you need to be ruthless. You need to shop around. That's why mortgage brokers generate, I think it's 70% of new mortgages now in Australia, because
Mm.
you need to be agnostic when it comes to the bank you're dealing with and get the best deal. They'll pull the wool over your eyes. They'll try and apply marginal tax rates to your foreign income. You don't have to do it, guys.
Yeah.
It's nonsense, and you need to speak to a specialist. Just on that whole buying an investment property, converting into a PPR,
Mm.
I actively discourage that for clients because sometimes you might be holding for 5 or 10 years. And generally speaking, a forever home is actually not a good investment. It might
Mm.
look great, but the expenses on it, the yield on it, the returns on it might be woeful. So you're better off buying that forever home when you're ready to live in it.
Mhm.
And quite often we see clients who buy a forever home in inverted commas, in Sydney, and then fast forward 5 or 10 years and ready to come home. They don't want to live in Sydney. They want to live in Brisbane or Melbourne.
Mm.
And suddenly they've had this noose around their neck for so long that it's the carrot is we got to live in this property, and then it doesn't happen. And then suddenly they've been paying all
Yep.
this money and had all this pain of managing this property to not actually get any benefit from it. So
Mm.
be disciplined. It depends on your time frame. If you're going to move back to Australia in the next 12 months, then yeah, it makes sense. You know with conviction where you're going to live. But if it's 5 or 10 years out, only buy a property if you want to have an investment and then the numbers stack up. Returns,
Yep.
yields, cost, expenses, the whole shebang. Don't buy a forever property because 9 times out of 10, they're actually not a good performing asset. So that's one thing I will say. And also too, it really comes back to people are changing their mind so quickly now. So clients can look in the eye and say, I'm going to do this. And then 5 years later, they go, oh, yeah, I said that. Yeah, no, it's not happening anymore. So, and the Australian government, both state and federal, especially punitive on taxes. Look
Mm.
at Victoria. I've got clients selling properties
Oh,
left, right, and centre out of Victoria because people
it's
are
a dog's
getting
breakfast,
20, 30,
Victoria.
40, $50,000 land tax bills. They're like, you know what?
Yeah.
I'm done with the place. So
Yep.
Sydney, New South Wales is pretty bad too on the land tax front as well. So clients are selling out of New South Wales as well. So do your homework. If you need to have a chat to someone who is impartial, not conflicted, chat to us because, we do this on a daily basis. Right, mate, let's head off to
Absolutely.
the next question. I think we covered that one off there.
Yep. So good question here from Ben Mackey. Are there options to lock in a foreign exchange rate? What are the pros and cons?
Look, it's called a forward rate agreement or a FRA. And yes, you can do it. OFX, who's one of our partners, does them.
Yep.
The catch is it costs.
Yeah.
So you're locking in a rate. They're taking on the risk of giving you that rate in advance. They price up the premium, think of like an insurance
Premium.
policy,
Yeah.
and you have to, once it's a contract. So, if you're locking in currently the dollar's at 66 cents to the US and you're locking that in 3 months time, and if the dollar falls to 62, guess what? You're getting 66.
Mm.
So it's a cost, but some people like it, some people don't. So definitely you
Yep.
can do it. It can be an effective tool, especially when you're moving a large lump sum of money, um,
Yeah.
like
That's
a house
exactly right.
settlement that, if you're happy with the price and you're
Yep.
risk averse, then pay the freight, lock in the rate and you're happy days.
Absolutely. And I think you're right. I think if you're sending it back a significant lump sum, it can be worthwhile. If we're talking an amount of probably under 100,000, I wouldn't recommend it or encourage it. Sort of, it needs to be that significant amount that's coming home, not that small stuff that you might be sending home as part of that dollar cost averaging.
Yeah, dollar cost average is probably a better strategy on those balances, the smaller
Yeah.
ones, because you can
Yeah.
nip away at it. And if you look at the dollar right now, she's jumped a lot, which isn't so good for expats. Bringing money back to Australia, good for those becoming out of Australia. But if the RBA holds its stance and no more rate cuts for 2025, and obviously the US Fed, did what they did, you might see the dollar 68, 70 cents the US dollar. Who knows? So just be mindful of that. There's a lot of press out there, discussions and debates about what the currency is going to do. So read that.
Mm.
But, to answer your question, Ben, yes, it can be done, but there is a cost of doing it.
Yep, risk premium, absolutely. Good question, Ben. Next question from Belinda Joseph. I'm currently a Thai tax resident and looking to open up a brokerage account that can invest in global ETFs. I don't trust Thai companies enough to use one of them and wanted to know what the options I have are in Australia-based brokerage companies or other reputable companies. Also, would opening an account with an Australian-based brokerage company be a data point that could be used against me in a tax residency dispute with the ATO? Great question, Belinda.
But it is a good question. She's right to be worried.
Mm,
Thailand's not exactly known for financial regulation. It's not even in the
no,
top 10 list. So
no.
you want that accountability, you want that one threat to choke when it comes to being able to hold people accountable. It's your hard-earned money, so you should have that. So you're right to focus on the jurisdictions that do have solid regulation. Obviously, most folks tend to focus on the Australian market because they're Australian, hence why
Mm,
they're in the group. But Australia is the highest regulated financial market in the world. Yeah, that's without a doubt. But also to the tax laws line up non-taxable assets, which are digital assets, shares, ETFs, managed funds, REITs, LEITs, crypto, no executive accrual on accounts based in Australia. So also too, as a data point from a residency point of view, it's not really a data point because you're investing as a foreign national. Even
mm,
though you're an Australian citizen, you're seen as a foreign resident. So
mm.
Thai people can buy shares in Australia just like you. So it's not really a precursor. And to give you an idea, and if you don't believe me and James, have a look at how they're formulating the new proposed tax residency laws.
Yeah,
Under the economic factor test, share ownership is not one of them. Property
no.
ownership is, but share ownership isn't.
Mm,
So there's no dramas there. As far as companies you can use, it gets difficult. So a lot of the discount brokerages have shut the doors to expats.
yeah,
Um, actually had this good discussion in Doha on Tuesday night about, people trying to wing it by using an Australian address to get around the compliance regime. And then just the butterfly effect that occurs from that when it comes to withholding tax and incorrect tax returns, and you save 150 bucks and you spend 2 grand refiling your tax returns. So to clean it all up. So don't do that, guys. There are a couple of small providers out there. Unfortunately, most of the access for expats now is what we call an advised account. And the reason
mm,
why it's an advised account is there's an advisor attaching to that account. And the reason for that is because the advisor has to do the know your client anti-money laundering common reporting standard requirements to vet that you are who you are and you're not Fatima sitting in Kabul laundering money for the Taliban. So there is a cost associated with that. So it's like the devil in the deep blue sea. The cheap, easy ways don't exist anymore, primarily because the regulations and the compliance regime's gone through the roof.
yep, yep. Good question, though. Great question. Another question here from Sam KS. Having been living abroad for over 10 years in the UK, how do I go about getting medical insurance when I move back to Australia? Do I need to do a probationary period or can I join in the UK first to enable me to get full coverage and move over from the NHS system? So medical insurance, private health insurance. Sam, good question on that one. So if we're over 30, generally you want to have private health insurance when you come back, or as soon as you get back. Technically speaking, when you come back, you have up to 12 months to actually get private health insurance. But the common thing that we see, I'd say very often, is that when you come back, you apply for private health insurance with one of the majors, and they actually load what's called the lifetime health cover loading onto your premiums because you've been away or you've been without private health insurance in Australia for a considerable time. Now, you normally would have to apply to the Department of Home Affairs to get I'd say a departure card history. That's not the correct
Passenger member
terminology there.
record, PMR.
Passenger movement record. There you go. And that actually tells the private health funds that you've actually been out of Australia for that entire period, which means that the fact that you haven't had private health insurance for however many years you've been out of Australia doesn't actually add to that period where you can be in Australia without private health insurance, which is just over 1,000 days technically after you're 30. So that's a couple of years technically that you can actually be without private health insurance, and that means they will automatically take off that lifetime health cover loading. But generally speaking, you can just look at coming back to Australia and then getting an appropriate private health insurance policy set up. You unfortunately would need to serve your waiting periods, even though you've been on the NHS system, which is, I guess, the Medicare equivalent in the UK. It doesn't matter. That's not private health insurance. So much like anyone, still need to serve your waiting periods if you've got things coming up. And, if you're not sure where to go to apply, then, using those online comparators, compare the market, those sort of things is a good starting point.
Oh, as an exception, not the rule. I have had clients who have had their waiting periods waived, but it's only in the case when they're moved from, say, Bupa overseas to Bupa in Australia. So there's
Yeah,
that
yep,
connectivity. Also, too, there are some funds that will recognise overseas health insurance,
yeah,
but they have to be known knowns to them to be able to
yep.
say, yep, we're cool with that, and yes, we'll wear that one. So yeah, it can be done. You can be bypassing the health cover loading, but yeah, definitely do a bit of research, get that passenger record, and that passenger record has to be done within the first 12 months, by the way. So don't leave it for a couple of years after being back in Oz, because that window closes, and then you will be paying the LHC.
Absolutely. And last question for today from Kathleen McDowell. I'm a dual US Australian citizen who plans to retire in Australia. When investigating whether my super will be taxed in the US once it becomes an accounts-based pension, I keep finding the answer, the US could tax it, and it depends on your accountant's interpretation of the treaty. Super, unfortunately, is not in the treaty, so bear that in mind. What's Atlas's interpretation given the US lack of clear exemption? Our interpretation, much like most of the US accountants and the US accounting partners we use, is that an account-based pension is taxable by the IRS if you're living and
100%.
residing in Australia, no question. The drawback, there's no tax credit because Australian account-based pensions, technically, they're tax-free in Australia. So it means that if you're a US citizen or dual national and you're leaning on the foreign tax credit system when lodging your US tax returns, there's no tax credit that actually exists in Australia that you can use to offset the taxes that would be due on the IRS or the US side. So it is taxable. It is one of the drawbacks of the US tax system and then taxing you on a citizen basis, not a residency basis. And it just means that as part of your overall arching retirement plan, that needs to be accounted for in conjunction with your US retirement accounts as well and your other assets and all those sort of things and doing some modeling around that. So, but good question, Kathleen, but yes, it would be taxable in Australia.
And also, if you're flipping on the other side, if you're thinking of retiring in France, UK, Spain, guess what? You'll pay local tax on your Australian allocated pension as well too. So Australia is probably the only super fund or regime that I know of that taxes in accumulation. Worldwide, the standard is they tax you in retirement. So
Yep.
unfortunately, it's good for us growing balances quickly because it's all tax free. The bad thing is no one gives us the benefit of that tax you've paid over the last 20, 30 years in that accumulation or that balance. And
Mm.
you will need to be strategic and creative in terms of how to navigate and manage that.
Yeah, absolutely. I think the benefit that a lot of people get when they've been in the US for more than 10 years is Social Security. That's just incredible. And that system, who knows whether that'll continue for the next 50 years, but
Mm.
no means testing on that one. So it's just what you pay in is what you get out, which is a terrific little income supplement as part of your retirement income streams.
And
That was,
just quickly for the folks in the US,
mm,
be very careful. We've seen this before, and it's a massive, expensive mistake. Do not draw out your whole super fund in Australia in pension phase.
mm,
We've seen that before. If you think about it, you've got a balance of $500,000 in your Australian super and you go, you know what, I'm going to live on my 401k or my Roth IRA or whatever it might be. I'm just going to clear out the Aussie super fund. You've suddenly created a $500,000 income supplement
yeah.
for the IRS. So guys and girls, this needs to be managed carefully.
Yeah, and I think speaking to that as well, I've spoken to a couple of Aussies living and residing in California recently, and they've been absolutely waltzed by the IRS in the last 12 months because they received advice from their Australian tax accountant about things to do with their super, and their tax bill was about
Oh,
tax
yeah.
bill was about 100,000, and obviously they're very angry. So just be mindful of the advice you're taking from individuals which aren't familiar with you being in the US or expat specific advice. Accountants get it wrong. They can be CPA or CA qualified in Australia, but they might not be, I guess, expat qualified or US tax specific qualified. So make sure any advice you're receiving is accounting for both sides of the coin.
Yeah, they don't know what they don't know. Great people and probably do great domestic advice, but when it comes to that second dimension, the cross-border side, we do see it quite a fair bit.
Mm, absolutely.
All right, James. Well, I think we've imparted a little bit of wisdom on the good folks on the call today. So thanks for your time, mate. Thanks for everyone on the call. Like I keep mentioning, all of us at Atlas are incredibly vain. So we do like to see reviews. We do like to see people subscribing. So keep it up. All we do is look at these little pinhole cameras. So we don't see you guys out there. We know from the data that you are there, but feed the
Fighting.
ego. We love doing this for you guys. And all we ask for in return is reviews, some feedback and a couple of subscriptions.
Beautiful. Thanks,
All
guys.
right.
Thanks for tuning in on another episode. See you on the next one. Thanks,
Thanks,
mate.
James.